Here we go, and good morning, everyone. Thank you very much for joining me for another fun-filled edition of the Real Estate Backstory. My name is Alan Rich. I'm the managing broker here at Max One Realty and Realtor Partners. I'm not joined with my partner today, Ming Richardson. She's out, so you're just stuck with me this morning. So I hope that we're ready for a good day. Every Monday morning, around 9 o'clock. Some days I started a little bit earlier, like today. Today I'm going to be teaching a class, so I want to go ahead and get our backstory out so everybody can kind of see it and get going, but I don't want to be late. So anyway, I was kind of jump right in and start off with some interesting, stats and figures here. So the first one is that, did you know that pets really do influence our choice of move? So there's a recent study out from National Association of Realtors, and what they found is that actually, pets influence the choice of the neighborhood as well as the house, and the statistics. Now, the younger the buyer, the more likely they are to let the homeowner or to let the pets help dictate that. So young millennials, it's about 30%, 29% of young millennials are heavily influenced by their pets. Even older millennials, 20%. You kind of see the graph right there. Overall, unmarried couples, single women, and millennials are the three groups that are the most likely to be influenced by their, for their home purchase by their pets. And so that's an interesting concept, because I know a lot of agents that completely kind of dismiss pets, and that's a thing that we really can't do if we're really going to be doing a really effective job of representing both our buyers and our sellers. Because sometimes our sellers are like, it's just no big deal, if my dog is out, and we have to let them know that really is a big deal. But also having fenced yards and things like that are also a really positive attribute that a lot of our clients are very much interested in. So, kind of gone are the days where we can just kind of like say, well, pets aren't important. Pets are very important, and we need to be aware of that. Now, one other thing that shapes a lot of our decisions, and this may seem actually kind of interesting, and at least I found this very interesting. So Redfin came out with a new study and said, like if you're going to relocate, where are you going to relocate to? And so they polled both renters as well as buyers. And it's similar trends, but for buyers especially, that's one that we're going to focus on, or for people who own a home and are going to relocate. 50% of their decisions were based on crime and safety. That's a really, really big deal. And so crime and safety is one of those things that's at the forefront of what our clients are looking at when they start talking about relocating, moving to different areas, and that kind of stuff. That's when you're talking about half of any particular group, that's a pretty significant impact. The other thing I found that was very interesting is in the past, cost of living was one of the biggest ones, mainly because, and we see it again and again in real estate, price is king, right? Well, 43% of cost of living, or 43% of the people are affected by cost of living, as well as by school quality. So of course, maybe not of course, but owners are more interested in the school quality than renters are, because I do believe that the renters kind of feel like, well, we always have a chance to move, that kind of stuff. After that, it moves down into taxes, climate change, and then racial diversity. Those are some of the big deciding factors for relocation. And so we really need to be ready to understand that, and understand the significance that basically crime and safety have, and how that impacts the real estate business overall. I want to jump right in and talk about Zillow. Now, Zillow is one of those things that has been, it's been a hot topic for the last week or so. And I've seen like agents going kind of on both ends, from, like on one hand, there's a lot of folks who are like, ding dong, the witch is dead kind of thing, and kind of dancing around on that. And am I a little bit guilty of that? Sure, absolutely, kind of thing. But we have to also look at, like what are the real numbers going on? What's happening? So, because there's also a certain segment, both inside the real estate industry as well as consumers out there, that see this as a telling tale of what's happening in the real estate market. That, well, if Zillow's jumping out, then the market must be getting ready to crash, and that kind of stuff. And really, it's not that at all. It really comes down to poor management, if you want me to be extremely brutally honest about it, kind of thing. So Zillow's coming in, they're closing down their home buying business, which we're all pretty excited about. They're cutting a quarter of their workforce, and they're stating that they've missed their earnings estimate. But I want you to understand how much they've missed their estimates by, and how much of a financial impact out there. So of course their earnings per share is down on that kind of stuff. But here's the real big deal. Okay, they generated $1.7 billion in revenue. On that $1.7 billion in revenue over the last quarter, they lost $422 million. Okay, so they earned, they brought in about 1.2 billion, and they lost about 400 million, or roughly 37% of that is their net loss on that one. And so, I think that we've seen this in our industry for a long time. There's just been a ton of us in the industry that have been like, there's no way that Zillow can keep going and losing money. We've seen where they've come in and they're selling houses for less than they're buying them for. And it's going again and again and again. Now, they also came out and said, listen, we just can't estimate the market, is one of the big things. At the same time, Zillow's internet media and technology business, which is as realtors what we are most used to seeing with Zillow, kind of thing, the buying of leads, the Zillow Flex programs, that kind of stuff. They generated about $480 million, almost $500 million was their revenue. Of that $480 billion, their gross profit was 130 million, which is about a 27% profit margin, which is a really great market. So, I think that for a lot of us, we've seen that the writing's been on the wall for Zillow for a long time. We knew that this was not sustainable long term. And so this is not really that huge of a shock, I believe, to most of us. I think we're glad to not see them out to necessarily having for our buyers to be competing with them, that kind of stuff. But to say that this is indicative of what's really happening in the market, that's not a safe bet, and I wouldn't go there. And I do want to show just a few more information here. So first thing was this was a Zillow problem. Okay, so if you look at their purchase price to the automated valuation model, you can see that whereas Opendoor and OfferPad both dropped their purchase price, you'll see that Zillow kept running theirs really, really high. At the same time, the gross margins for both Opendoor and OfferPad were both in the 13% range versus Zillow, which is at 9.1. And when you're dealing in billions of dollars, being down 4% in margin, that's a really, really big deal that adds up over time. So, we have to be, observant of what's really going on with that, how that's going to impact us. At the end of the day, for Zillow, it affected their net profit, net loss, of course. Opendoor and OfferPad are just now starting to show a net profit per home. Now, here's the interesting thing, is that if you take up Opendoor and OfferPad are each showing between $6,000 and $7,000 net profit per home for Q2 in 2021, and it's their best one year to date. Now, that's before you take any of their expenses. That's before you take and you can't open up Facebook or go on Google and not see an Opendoor or an OfferPad ad for the most part. So that's before their ad spend. That's before any of their operating costs, that kind of stuff. So Opendoor and OfferPad, in addition to Zillow, have been operating at a loss for years, really ever since they've been doing it. So they are starting to show a profit per home, but they're not showing any profitability as a business. And I think that we are going to see where some of the folks that have been investing in the iBuyer side of things with Zillow is now going to start looking a little bit more discretionary at Opendoor. I would also be looking for Opendoor and OfferPad to be raising prices just a little bit more, because I think we're going to start seeing more scrutiny on their numbers. For the last 3 years, especially, they've kind of been this golden boy that where investors have just thrown massive amounts of money at them, and they continue to lose money. And I think that time frame is starting to close up. So again, I'm not trying to relish in the failure of Zillow's iBuyer side of things, but we still need to know that this was a Zillow problem. This is not a market-driven issue. This is not, we've seen property values down. This is it. It's really hard to scale, and come to find out, who knew that selling and buying real estate, you needed a local professional on the ground. How about everybody but them? So, on that side of things. The House finally passed the bipartisan infrastructure bill. And so I just want to touch on that because, some things that it does make a big impact with, especially when it comes to housing, is going to be to make broadband. Broadband is going to be much more prevalent, faster. Also, we've seen where, especially in housing during COVID, a lot of folks moved out of town. A lot of folks moved away from infrastructure. Well, now we're going to see where there's like a $65 billion investment in broadband, and that's going to make these smaller outlying communities even more popular. And as time goes on, because there's going to be a lot of money that really continues to flow into that. We are still waiting on the Build Back Better program kind of thing, and I'm not getting political. Goodness, I promise I'm not getting political out there, but it just kind of is where it is right now. Now, it does have some interesting provisions, at least on the last version. We won't actually know what's coming out kind of thing, but there's going to be a lot more stuff coming out for affordable housing and down payment assistance, primarily focused around minority groups. But again, it's hard to really hey, this is what's coming, because everything seems to be on the table and then back off the table, then back on the table again. So all in all, we've really kind of seen where that really is starting to dry. Well, this is going to be of no surprise anyway, that our home price appreciation has really been huge this past year. And so, and what's been interesting this year, as opposed to in past, when we saw market escalations. Market escalations in the past were primarily focused a lot of times around low to middle values, and not necessarily across the board. What we're seeing now is that it doesn't matter if you have a $100,000 house or you have a $800,000 house. The price appreciation is kind of spread out across all the price points. Between now the low, our lower, our value style properties are seeing a higher appreciation rate, but it's not like expensive properties are not appreciating as well. It's a difference from 22 to 19%. Overall, we've been running at about a 21% home price appreciation for the last year. Now, is that probably going to be going ahead? No, I don't think so. I think we're really kind of where we're looking at being, and I think that this is much more realistic, is that we're looking at about a 3 to 5% home price increase over the next year. I do think that the things that are coming along with the Fed are really going to be impacting that. So we have seen where a lot of home prices have really been rising and rising and rising. And let's face it, inflation is going to start taking kind of a bite out of that. So in addition to that, our labor market really is tightening up. And the thing that happens with that is that at the same time, wage costs are accelerating, which is then driving inflation even more. So on the positive side, jobless claims fell again, and continuing claims continue to fall. But at the same time, unit labor costs, meaning the cost of labor, is going up. But overall, that's really kind of hurting our productivity, largely because there's a huge, we've had just a massive jump in inflation. And so, this jump in inflation is kind of interesting because, I know there's a lot of stuff going on in this graph, but what I wanted to kind of share with you here is that even though we've seen labor costs huge, so the darker blue line shows where workers' wages are right now and where that's really been shooting up. The thing is that the real compensation per hour, how much we're making, how much we're taking home after, even though everybody's getting paid more, with the challenges with inflation hitting us right now, you can see it everywhere from home prices to gas prices to everything in between, well, you can see that actually it's hurting us more, kind of thing. Our real compensation is actually dropping. Now it's a little bit better than it was, in over the last couple of months, but still, we're seeing where folks are making more but taking less home, if that makes any kind of sense. So again, our jobless claims came down to a new pandemic low, which were really good. Interest rates this past week, or for this week coming up, we took, I'm not going to say a dip. It went from 3.14 to 3.09. So we're still in the threes, kind of thing. Mortgage applications fell a little bit last week. We are down about 9% from a year ago, but things were crazy from last year. We're still in really, really good shape. Refis, we're going to continue to see refis falling off as interest rates are inching their way up, and we are going to see interest rates inching their way up. I'm not hoping for it. I'm just saying, get ready, because here it comes. Now, here's where that's going to happen, is that the Fed has announced that in November, and what month are we in? November. The Fed is going to start tapering bond purchases by about $15 billion a month over the next few months. Now, will the Fed raise the borrowing rate? Right now, the borrowing rate sits at 0. And it has been since, COVID struck, kind of thing, ever since March of 2020. And so are they going to raise that? I don't think that they'll raise that until they taper bond purchases. They don't seem to have any kind of desire really to do that. And the fact is that like I'm part of the Fed, not really, but the Fed has been buying around $120 billion in monthly bond purchases, and they're tapering that down by about 15 million a month. So, this is slowly going to wind its way down, and that's really what they're trying to do. They're not trying to have this massive drop in it. So they're dropping it by about 10% a month is what they're kind of, 8 to 10% is kind of their target to try and do that. But inflation, I think the Fed has kind of been behind the ball on inflation as far as I'm concerned, because if you look, we've seen where inflation has been. I think we've all been seeing inflation happen much more so, and the Fed kept saying it was transitional. It was immediately just going to go back down. And I don't think any of us really think that was what was really going on. So, but when the Fed starts driving down the amount of bonds that they're buying, that is going to continue to drive our interest rates up. We need to be communicating this to our buyers. Now is the right time. Rates are going up. They're not going to be going back down. And at some point, when the Fed does raise, the short-term borrowing rate from 0, that's going to drive them up even further. So the best thing you can do is really communicate this to your clients, because it's important. This is the cost of what it's going to cost them if they wait until next year. I mean, today's rates are right around 3%. It's still 3.1. But if you wait until they're 3.5, well, guess what? Your client's going to spend about $107 more a month to go up about a half a point. So if they go up, a whole point, that's going to be about $200 a month that they're going to have to be going up in home price to get the same value of home that they get today as they would in the future. So when I say, why do I see price increases going from, home price value increases going from the 20% down to 3 to 5, this is going to be one of the biggies, is because we just can't afford it. Our buyers will not be able to afford as much home as they can right now. And, people set their expectations. People have been out there buying and looking at homes right now, and all of a sudden their buying power is going to go down when home purchase goes down. At the same time, we have got to get ready for a flood of foreign investors. Okay, so the U.S. just lifted the travel ban on 33 countries, including Europe, Asia, that kind of stuff. Most foreign real estate buyers have not been that interested in being here. Buying real estate if they couldn't. In 2018, foreign investors bought around $267 billion, $183 billion in 2019. It's less than $100 billion for 2021. So we look to be able to probably double what foreign investors are going to spend in the U.S. real estate market over the next year. So we need to be ready for that, because that is going to be another force that comes in and helps to steady and drive real estate values. The other thing is that the millennials are continuing to be a big force in our market. So the millennials are looking to keep housing strong for a lot of years to come. Right now, the millennials only account for about 22% of our population. However, they're making about 37% of all home purchases. So, they are really driving a big piece of what we're seeing in the real estate market. All right, we're jumping over into more of the kind of like, news for realtors here kind of thing. So if you are an old dog, maybe it didn't sound right, but if you've been in the business for a while, you may have a Super Express key. We used those years and years ago. It's what you'd use to open a lockbox. I still know a lot of folks that love them, but guess what? They're going away on December 6th. Nothing's going to work with them, mainly because they worked off the old 3G networks, and that technology is really being shut down. So if you have been in the business for a while and you have an Express key, understand that sucker is going to be a paperweight here soon. So you're going to have to get that thing wrapped up. Where are Georgians moving? So this is there was a recent study said, what are the states with the largest share of movers who stay in state and move out of state? And Georgia's the fourth highest state in movers that stay in state. So, the average move here in Georgia is about 14 miles. And what that really means for us is that the vast majority of times when we represent a seller, there's a really good chance we're going to be able to represent a buyer as well. For folks who do move out of state, our number one state of choice is sunny Florida. We like to go to the beach, I guess. So, all right. Green is our top paint color for 2022. Green is very trendy. So all the big paint companies came out and they said, what's going to be your paint color for 2022? And they all basically said, green, 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 green. Green is going to be the big deal. Now, what are the paint colors that we hate? Orange and pink. Please don't do your homes in orange and pink. Orange and pink are no-nos, and you will turn off a buyer if you're painting your house in oranges and pinks, which I can kind of understand. That sounds pretty hideous. Our builders are having a real challenge out there on labor. Labor shortages are starting to drive even more issues for our home builders right now. Matter of fact, they have now issued a crisis level labor shortage for the National Association of Home Builders. Issued out that is right now one of the biggest challenges that they have. In addition to the supply chain issues and rising prices, that's one that is a biggie for our builders. So we're seeing where and really I bring this up not because I'm trying to defend the builders. They do have a lot of challenges, but why are our builders not building cheaper houses? Well, the materials cost more, the labor's costing more, they can't find it, things like that. All these are part of what's driving, the new home values that we've really been seeing. If you were a renter last year, you missed out on nearly $51,000 in equity this year. We've seen where rental increases have been climbing. The national rent is up 16.4%, which is astronomical for rents. And guess what? They're not going away. Those rental increases are going to keep going up more and more. Part of that is inflationary. Part of that is because rental prices are also built in or based on the value of the homes. At the same time, if you owned a home last year, well, now your home has grown considerably in equity, kind of thing. Now, that number of 51,000 in equity, that's for all, that's including the houses over, $3 million and that kind of stuff. So, we don't really see here in Georgia where the average equity is 51,000. It's much closer to $25,000 to $40,000 in that range, kind of thing. But still, when you look at how much it's costing our renters, they really need to get in the market. It's important that we help them, because in addition to not taking part of that equity growth, some rents are now up 40%. So CNBC was issuing did a new study and really put it out there that while there are some modest markets that are only seeing a 7-8% increase, some markets are going up by 40%. Almost half the rent prices are increasing. And if you've been looking at rentals and helping tenants and landlords and that kind of stuff, you can see the exact same thing. Back on lumber prices again, we are, guess what? Lumber's going back up. So, we're not, lumber does not really pose any sort of real help for us here coming along. Lumber is, right now, lumber, we saw a nice drop in lumber, but guess what? It's going back up. They're saying that lumber is going to be about 40% higher than where it was even pre-pandemic before it went back up again. So, and that is, in my opinion, largely inflationary because there's no real reason for that to truly be hitting us just that way. This week on as far as training goes on, so today in the airport office, I am doing relaunch, which is our 25-hour post license. You do have to be in the airport office to take advantage of the 25-hour post license. In addition, we have lead generation in today's market, which is in person or virtual here at the airport office. Tomorrow we have our monthly sales meetings, and that's in all of our Maximum Partners offices. Wednesday, I have in the airport office in person and virtual is marketing and technology secrets. Hope that you can join me for that one. Also on Wednesday over in our Conyers office, we're having a pop by workshop power hour over there if you want to get a free lunch and work on your pop bys and that kind of thing. And then Friday, I'll be back here at our Conyers office again. I'm sorry, at our airport office, going over business planning. And now is a really good time to start looking at your business plan for what are you going to do next year. We need to start building our business plan. That one is a really important factor as we move ahead because your business plan, well, let me back up. If you don't have a business plan, then it's real easy not to really worry about it. But once you start putting a business plan, once you throw that out there into the world about what it is that you're going to do and how you're going to try and grow your business, you've now drawn that line in the sand, at least mentally, that you're prepared for. So the only other thing we have really going on as far as training goes is that coming up, later on in November, I'm going to be starting some team lead training where we're going to be doing in-person Zoom training for team leads. And if you're looking to grow a team, I'm going to encourage you. So be looking for that to come soon. So I hope you guys have a really great week. If I can be of any service, please call, text, smoke signals, give me a holler. Y'all have a great week. Thanks.